You're concerned about the economy, and you have no idea how the banking system works. To be honest, both are complex and confusing systems. And the worst part, you can't control what happens with your money if you don't first understand how the banking system works. Hello, and welcome to Markets. This is Eric, and in today's video, you'll learn how the Fractional Reserve Banking System works and understand how it affects your, mine, and everyone's money. Under a fractional reserve banking system, banks are required to keep a certain percentage of their deposits on reserve, but they can lend out most of that money, hence the term fractional reserve banking. In principle, the fractional reserve system was created as a way to store money safely and lend it out when it is needed. And up to this day, fractional reserve banking is done by the majority of banks that are active in the global economy. Inaccurate to pinpoint a specific date for the origins of fractional reserve banking. Prior to the emergence of formal monetary authorities such as central banks, fractional reserve banking started directly from the bankers' recognition that not all depositors needed immediate access to their funds. After all, when depositors lose faith in the ability of a bank to give them back their money, they will try to withdraw as much money as possible at the same time. If, in response, a bank could not raise enough funds by collecting loans or selling bills, the bank would either go bankrupt or default. This condition is called a bank run and is still the most common factor behind the collapse of banks. We may have not concrete dates, but we do know that fractional reserve banking was already common during the Middle Ages. In fact, some economists have already pointed out that banking crises have been a recurrent feature since the early 14th century, when fractional reserve banking became the dominant business model of banks in northern Italy. Towards the end of the 17th century, bank runs resulted in the establishment of central banks. The Swedish Riksbank was the first central bank, established in 1668. Many other nearby countries follow its lead to create central banks, with the power to set reserve requirements and determine the way in which such funds, known as the monetary base, are handled. The emergence of central banks substantially reduced the risk of bank runs, which are inherent in fractional reserve banking, and permitted the practice to continue as it does today. In a nutshell, banks hold a fraction of their deposits or reserves as deposits at the central bank and lend out the remainder. And to anyone's surprise, the reserve requirements are set by the central bank. Moreover, based on such reserves and the public's preference for holding cash, there is a fixed money multiplier, which is the ratio of brought money to central bank reserves. It is called money multiplier since a given amount of reserves multiplies into a much bigger amount of bank lending. The money multiplier can also be seen as a measure of the extent to which deposits are created from excess reserves. And the central bank supplies reserves to the banking system via open market operations or discount window lending. If a central bank increases the reserves percentage and given the fixed money multiplier, bank lending and deposits, aka the broader money supply, should increase as well. This explanation will appeal to anyone who has started a recent course in economics or has consulted a textbook. But in practice, banks make loans and find reserves after the fact when they need to. If the central bank has a reserve requirement in place, then the central bank will provide the amount of reserves necessary for the banks to satisfy the regulations they create. The reason is that modern central banks, in general, focus on a temporary, usually overnight, interest rate in the interbank money market, a market in which banks lend and borrow their respective central banks' reserves. They do so by readjusting the amount of reserves on their balance sheets to ensure a sufficient level of reserves are maintained at all times based on their policy. The adjustment involves making sure that the reserve ratio do not get too low or too high. Too low in the sense that it would put upward pressure on the interest rate, and too high that it would put a downward pressure on it. Therefore, the central bank must offer a particular percentage of reserves to meet its target for interest rates, and that percentage is typically determined by the minimum reserve requirements. If bank lending rises, and the associated spike in bank lending rises the minimum required reserves, the central bank will provide such reserves. If the opposite happens, the reserve balance will drop due to the central bank's lack of reserves, and the interest rate will rise as a result. That way, the central bank won't hit the interest rate target. During quote-unquote normal times, the central bank is unable to target an interest rate on its own and independently restrict the amount of reserves it offers. In the US, for example, is the US Treasury the one that prints net financial assets. Meanwhile, the Federal Reserve, via programs like quantitative easing, changes the composition of those assets after the fact by buying assets. That involves creating new reserves and removing a T-bond from the private sector, to be more specific. These changes in the composition of asset holdings are what drives changes in the monetary base. A developed economy is fractionally reserved in the sense that investments constrain how much money it can realistically create. So, instead of calling it a fractional reserve system, a better term is a fractional wealth system, since the banking system is always leveraging our existing wealth to create new financial assets, financial liabilities, and wealth. In a very simplified way, this is how the entire banking system works in the long run. It's also why debt, along with assets and net worth, virtually always increase in the long run. So, yes indeed, the entire banking system is structured as a fractionally reserved system to create more assets, liabilities, and wealth over time. However, the idea that the central bank is somehow at the core of all of this can be quite misleading. Banks have the option to fractionally leverage their balance sheets, but their reserves are just one asset among many that make that process sustainable. The advantage to banks for keeping fractional reserves is pretty obvious. They can earn a substantial amount of interest on the lent out funds. That's nice if you're a banker, but what about the customers? Well, assuming a healthy degree of competition, it means that banks have to offer fractional reserve accounts that charge zero storage fees and even pay interest on deposits. Sure, the interest they pay falls short of the interest they earn by merely enough to cover the amount of money spent of safekeeping and payment services. But hey, at least you're getting something useful in comparison to leaving your money underneath the mattress. As a net positive, fractional reserve banking can create synergy between payment services, such as checkable deposits and banknotes, and the process of intermediation. That means pooling savers' funds for lending to selected borrowers. Fractional reserve banking does have its major downside in the form of higher default risk. I have previously said that in the case of a negative return for a bank, the depositor won't recover all of its money, and in more extreme cases, none of it. Several reasons might explain why bank runs occur. Some of them are rumors of financial distress at the bank, a declining performance of the economy, or exposure to other troubled banks and financial institutions. Ironically enough, just the rumors of illiquidity can turn into a self-fulfilling prophecy and the depositors hurry to withdraw their deposits. And then again, the bank runs out of liquid assets to satisfy these requests and defaults. In practice, when deciding whether to choose a bank account contract or a warehousing contract, a customer will have to consider whether the profit derived from saving on storage fees and interest earned on his or her deposits is greater than the risk of not being paid at all. Historically, in competitive financial systems, where banks are free to strategically diversify their investments and capitalize their operations, well-informed consumers thought the best option was to select a fractional reserve bank over a warehouse. In fact, for robust banking systems before deposit insurance, the risk of loss was particularly modest. In addition, the interest rate on deposits and storage fee savings were significantly higher. Fractional reserve banking is a system that allows a simple process for the creation of money. It does this by allowing banks to lend out more money than they actually have in storage. Some say this system is an abuse of power because it allows banks to create money out of thin air. On the other hand, many say that the system allows an economy to function efficiently by enabling people to take out loans easily. During the boom phase of the business cycle, fractional reserve banking magnifies such boom. In the boom phase, banks can issue new loans at a faster rate than savings are withdrawn, which increases the money supply and stimulates economic activity. In the bust phase, bank runs cause the money supply to shrink, which makes an already bad situation even worse. The fractional reserve system is largely intertwined with the boom-bust cycles that have characterized capitalism since its inception. As we have seen, fractional reserve banking is like a double-edged sword. Yet, although it has several shortcomings, fractional reserve banking remains as the most widely used type of banking, which is clear by its widespread presence around the world. In order to face its shortcomings, some proponents say that the best long-term policy response is not a permanent increase in the reserve requirements, but rather a healthy mixture of good macroeconomic policy, better practices for risk management, and sound financial regulation. While others state that a fractional reserve banking system can be stable when crippling legal regulation and bank privileges are absent. In terms of legal regulation, some people say that branch banking limits reduces diversification of assets and deposit sources, indirectly limiting operational capitalization and hampering the effective allocation of reserves. And in terms of privileges, is that the weakest banks today are not the smallest, rather the largest banks, since they concentrate most of the operations in the global financial system. That in turn amplifies their systemic risk and leads to the too big to fail doctrine. These two conditions can be abused by major banks and lead them to hold asset portfolios full of default risk and/or interest rate risk, which can be magnified once we add their financial leverage. That's it for this video on fractional reserve banking. We've covered plenty on this topic, so let me know, what do you think about this banking system? Do you think it's the world's largest financial scam? Or just a convenient tool that can be abused? What would you change about it? Please, share your thoughts in the comments. This is Eric from Markets, and I hope to see you in the next video.